Welcome to our webcast titled, Will Your Fixed Asset Controls Stand Up to an Audit? Brought to you by CFO Publishing and by the sponsor of our webcast, Sage. I'm Joe Fleischer, and I'm a webcast producer with CFO Publishing. I'd like to tell you now about our very distinguished panelist and moderator for our webcast. Joining us today are Mark Bobber, Managing Director, Fixed Asset Management and Insurance Solutions with American Appraisal, a division of Duff & Phelps. Grant Griebel, Sage Fixed Asset Solutions Engineer with Sage. And our moderator, Chris Schmidt, Director of Research and Custom Content with CFO Publishing. Now, by way of background, we will initially hear some perspective from Chris. Actually, we'll hear from him fairly soon. We will also hear perspective from Mark Bobber. I mentioned that he is Managing Director of Fixed Asset Management and Insurance Solutions with American Appraisal, division of Duff & Phelps, and he assists manufacturers, telecommunications leaders, universities, healthcare systems, and state and local governments in developing accurate fixed asset records to satisfy Sarbanes-Oxley compliance as well as various other requirements. And he has expertise in market value studies for mergers and acquisitions, joint ventures, and other divestitures within the healthcare community. He is involved with computerized reconciliations, we'll talk about those in a bit, and the creation of reports that utilize multiple software systems, and he works directly with clients to convert fixed asset reports to accommodate the respective software systems. And we will hear as well from Grant Griebel, whom I mentioned is Fixed Asset Solutions Engineer with Sage. He's been in the software industry for a number of years, helping customers to get the most out of technology solutions for their businesses. He works with Sage Fixed Assets, or specifically the Sage Fixed Assets team, and has developed a depth of knowledge which will be very clear on processes, implementation, software use cases, and best practices. At this stage, it is my pleasure now to outline the agenda. Chris will start off after we pose our first polling question, discussing the major forces affecting fixed asset management. We'll then hear perspective from Mark Bobber about fixed assets and particularly the biggest number on the balance sheet. And finally, we will hear from Grant Griebel of Sage about the supporting role of technology, and then we will open the floor to your questions. But at this stage, what we would like to do is pose the first of three polling questions that we will intersperse throughout our webcast. And the first of these polling questions asks, how confident are you about your current fixed asset information? So what you can feel free to do is select the radio button that corresponds to your answer and then click on the Submit button. From top to bottom, the choices are very confident, confident, unsure, not confident at all. You can select the radio button that corresponds to your answer, and so that we can record your response, you would then click on the Submit button. Again, we want to find out how confident are you about your current fixed asset information. The choices from top to bottom, very confident, confident, unsure, not confident at all. Again, select the radio button that corresponds to your answer and then click on the Submit button so that we can record your response. We will give you just a few more seconds to respond to this question, and then what we will do is reveal how you have responded. And so far, what we can see is, this is interesting, a majority of respondents, more than 6 out of 10 have indicated that you are confident. It will be interesting to see if your point of view changes throughout this webcast. At this stage, it is now my pleasure to turn the floor over to our moderator and to our very first speaker. Once again, Chris Schmidt of CFO Publishing. He's Director of Research and Custom Content with CFO Publishing. Please give a warm welcome to him. Thank you very much.
Thank you so much, Joe. I'm very happy to be here today with Mark Bobber of American Appraisal and Grant Griebel from Sage to discuss a topic that's meaningful to anyone who's interested in helping senior finance executives become more effective in their roles, and that's the management of fixed assets. Effectively managing fixed assets doesn't just lead to a healthier appearing balance sheet. Managing fixed assets well helps companies reduce their operating risk and improve their overall business performance. To get us started, I'd like to talk about three of the main forces that we at CFO Publishing think are creating fixed asset management challenges for CFOs and their teams. The first is a trend toward regulatory scrutiny, in particular a changing regulatory landscape. The second is intense tax enforcement pressure. And last but not least, the third is the increasing business complexity that every growing company is faced with. Each of these three forces contributes to an increased risk exposure related to fixed assets, that many companies are working very hard to address. There are several dimensions to that risk. There's certainly compliance risk with all the reputational factors that accompany compliance matters. There are also operating risks that appear when companies struggle to account for location and condition of their fixed assets. For example, in the case of a major disaster. The reason we bring this up now is just to remind our audience that this is not a discussion about accounting. It's about managing risks as well. So let's begin with the first big force affecting fixed asset management, and that's regulatory pressure. Since the major accounting scandals in the early 2000s, several of which were tied to the accounting of fixed assets, there's been a big push toward increased regulatory scrutiny and greater transparency in reporting. It's reasonable to say that the accounting of fixed assets in the pre-Sarbanes-Oxley area, while it was not really simple, was viewed by most companies and their auditors as pretty routine. What's happened over the last 15 years is that widely accepted notions of what is routine in accounting and what isn't routine have been turned on their heads. In fact, there was a period of several years where really nothing was routine. We're finding that even small and mid-sized firms are dealing with a wide range of regulatory regimes. Look at the list on the slide. Many companies, especially as they seek growth in new geographies, are finding themselves subject to a whole range of new regulators. In the realm of fixed asset management, change is a constant. Companies are constantly leasing and acquiring new equipment and facilities, depreciating those things, working to inventory them, retiring them, and acquiring more stuff. Companies' operating requirements are constantly changing too, which means that their fixed asset picture is, by definition, also changing. And the regulatory landscape too presents a moving target for finance teams that are working to account for fixed assets accurately, transparently, and reliably. One of the most disruptive shifts that finance departments have been trying to deal with is the attempted convergence of U.S. GAAP and IFRS regulations. What was once envisioned as a single set of global accounting standards is now, been dumbed down to attempted convergence on specific standards, most notably, I guess, on revenue recognition. But still, there are several dimensions of further GAAP IFRS convergence that are relevant in the realm of fixed assets, having a potential effect on your balance sheet. One example is the carrying basis of assets. GAAP has used historical cost as a basis. IFRS has used historical cost as a starting point, but it also allows for revaluation of fixed assets to fair value. There are also differences in ways component depreciation and impairment of assets are treated, and there are substantial differences in the treatment of operating leases as well. Moving on, tax legislation and enforcement pressure represent the second major force that we've seen take on greater influence in the fixed asset management space. One after effect of the last recession has been a distinct uptick in tax enforcement pressure. Governments are facing fiscal deficits, and the overall climate of austerity is yielding calls for greater corporate tax contribution. In general, the CFOs that we survey here at CFO Publishing expect that tax-related disclosure and transparency requirements will continue to increase. And they continue to report more aggressive audits in the jurisdictions where they do business. The slide shows a survey finding that we recently had that confirms this notion. And because the accounting treatment of fixed assets is such a central tax issue, it stands to reason that as tax reporting undergoes a shift toward greater transparency and more intense scrutiny, taxing authorities are going to be looking very closely at the tax treatment of fixed assets. Finance and tax departments are especially motivated to ensure that the reality of their fixed asset positions are reflected in their reporting. Because when reporting fails to reflect reality, companies are recording assets that don't exist because they've been damaged or retired or stolen or otherwise disposed of. And that can lead to overpayment of taxes and insurance premiums. And Mark and Grant are both going to talk about that later. Because fixed assets are so thoroughly grounded in physical operating realities, a company's growing business complexity leads to an increasingly complex fixed asset profile. This means that companies of any appreciable scale are often managing fixed assets along multiple dimensions, multiple sites and geographies, multiple inventories that need to be cataloged and tracked, multiple construction and installation projects underway, multiple funding sources for those projects, and of course, multiple reporting and tax regimes being applied to all of these. The result of this ever-growing body of activities, initiatives, and requirements is an ever-growing set of data on fixed assets that companies are working very hard to manage. Mark and Grant will be talking about some of the information and information technology issues in this area in more detail. But I did want to mention that our own research here at CFO has shown that many companies still continue to manage fixed assets using a combination of spreadsheets and manual processes. Notwithstanding that finding, our audience does recognize the value of inventory and asset management systems and technology that can create tight and efficient links between the complex, ever-changing reality on the ground and the financial reporting of that reality. IT systems that allow for the kind of flexibility in analysis and reporting that can help companies respond to evolving tax and regulatory requirements. One of the business paradigms we touch on again and again here at CFO Publishing is the relationship between complexity and risk. The ability to manage and thrive amid increasing complexity is a hallmark of the successful modern enterprise. Globalization, the search for greater efficiency, the desire for geographic expansion, they're all forces that cause companies to extend themselves into new products, new business lines, new sourcing and production arrangements, and new inventory and manufacturing practices. And as companies increasingly extend themselves in these and other ways, they are also conscious of an accompanying increase in their exposure to risk. For example, a series of natural disasters in recent years, which disrupted supply chains and manufacturing, raised awareness among the CFOs we speak with about the very real risks of physical disruption to business activities. And that's why we've seen an increased focus in recent years on resilience and on practices that companies are bringing to bear to mitigate these types of risks. In fact, many of the same practices that support fixed asset management in general also serve the overarching goal of becoming a more resilient organization. From the point of view of the CFO, the single broad overarching characteristic of fixed asset management is that it's a moving target. Every single force that I've touched on so far is characterized by change and movement toward greater regulatory transparency, toward greater tax pressure and exposure, towards increasingly complex cross-border business activities. And companies' fixed asset profiles are in flux as well to match that level of change. So it's clear why issues related to fixed assets are key components of the larger pressures and forces of change that CFOs are contending with. It's a realm that's become more complicated and more challenging to manage in recent years. With that, I'd like to hand the floor over to Mark, who's going to talk about how he helps organizations tackle the fixed asset management challenge. Mark, the floor is yours.
All right, great. Thank you very much. Appreciate everyone joining us today. Welcome. I'll jump right into it just a little bit, just give you a quick overview of what I'm going to discuss today. First of all, just a really quick Fixed Assets 101 overview. I talk a little bit about the scrutiny of fixed assets, past and present, a little bit some of the basic things as far as internal controls over fixed assets, as well as some best practices and current practices as it relates to inventory, as well as reconciliation process. And then something that, you know, a lot of organizations run into challenges with is capital budgeting, and want to just talk a little bit about how a good solid inventory, good solid fixed assets can actually help your organization with capital budgeting. And then talk a little bit about reporting aspects, as well as if you are looking for outside assistance, you know, what to look for as far as qualified fixed asset consultants. So as we jump in, I want to just lay the groundwork today. Hey, what happens here today stays here today. So make sure you guys all note the first rule of what happens in accounting stays in accounting. Okay, a little bit of comedy aside, give a quick overview of fixed assets. Most of you already know this. They represent long-term tangible assets an organization uses, useful life greater than 1 year. Typically, as most of you are well aware, they fall into the following broad categories: land improvements, buildings, M&E, CIP. We also know there's a lot of other subcategories that can be utilized, but essentially these are kind of the main buckets that essentially fixed assets fall into. And as most of you are probably aware of, but sometimes it gets overlooked a little bit in the process, is that fixed assets typically are the largest line item on the balance sheet. And historically, as it was in the past, they received some of the lowest scrutiny, but that is actually changing. So from a scrutiny standpoint, going back to the past, and when I look at past and present, I'm thinking about the early 2000s, probably Sarbanes-Oxley, some of the major frauds is kind of the turning point. But essentially in the past, things were basically handed over to a low-level auditor. Very little scrutiny was placed on fixed assets. Very simple analysis were done, quick review of the roll-forward analysis, some reconciliation, some reasonability test of current year depreciation, and probably just a test basis of just high dollar items. Essentially, not a lot of scrutiny was placed on fixed assets. So essentially, things could go awry very, very quickly. Well, what happened? Well, most of you are aware of some of the large fraud cases that are out there, Enron, MCI, as well as Health South. And two of those cases represented, the representative of the fraud was actually in the fixed assets. What all that led to was Sarbanes-Oxley, which I'm sure most of you are familiar with, Section 404, obviously increased testing and internal controls. One thing that definitely grew out of this was the internal audit function. A lot of organizations developed an internal audit function or actually outsourced that to other companies to actually perform it in addition to the external audit function. But essentially there was a greater realization that fixed assets were, these are the biggest numbers on the balance sheet, and, we, and as well as other places, aren't spending enough time on it, and oh boy, it led to some additional challenges that most of these organizations were not expecting. And one of the messages from today, and I'll get into this a couple times, is that fixed asset issues don't tend to, they don't sneak up on you. They basically don't sneak up on you. They essentially do sneak up on you, and they don't happen overnight. They kind of sneak up on you, and before you know it, you're left with a major, major issue. So, but all this has led to increased scrutiny over internal controls. Now, what are the internal accounting controls? Well, there's a variety of them. I'm just highlighting some of the basic ones from a fixed asset perspective. Just talking about the simple transactions day-to-day of acquiring assets, disposing of assets, and then allocating those costs to reporting units via depreciation. That's the simple aspect. As far as the purchase and capitalization of fixed assets, there's different processes in place, issuance and approval of PO, receipt of the assets, payment of the assets, and then essentially posting that asset to the subledger. So those are the controls that are essentially in place. Well, what are some of the deficiencies that can actually occur during that process? Well, one of the big ones is really that posting of the asset into the subledger. What typically tends to happen is information is keyed off of an invoice or a purchase order by someone that may or may not know actually what the asset is. And essentially whatever gets keyed into the subledger is what resides with that asset for the rest of its normal life. So what ends up happening sometimes is you don't get a specific description, you don't get a manufacturer, a model, or serial. You might not. And in many cases it'd be very, very, very generic and very, very difficult to understand, and I'll get into that in just a little bit. Most organizations don't use any form of property identification tags, or if they do, they may assign a tag number, but the tag itself doesn't necessarily always get affixed to the individual unit. It sometimes gets affixed to an invoice or a purchase order sitting in someone's file cabinet, but doesn't actually hit the asset, which is actually on the floor. There's also inconsistent application of capitalization thresholds, and basically just looking at what an organization uses as their capitalization policy, whether that's as low as $500 or $1,000, or maybe as high as $2,000, $5,000, even $10,000, depending on your institution. Those things can be inconsistently done. And this is one we run into quite a bit. No cost segregation for CIP. Organizations, companies, institutions go through significant renovations, modifications, enhancements. Significant building projects go up, and they're big, big dollars. Well, what ends up happening is a lot of times those construction projects contain a significant amount of equipment, whether it's furniture, computer equipment, manufacturing equipment, processing equipment, you name it. And in many, many cases, the equipment dollars actually get embedded into the building or the construction entries. Well, two problems happen. You don't have the appropriate detail for the equipment itself. Furthermore, from a depreciation standpoint, those assets get actually lifed out at the life of the construction or the building. So it could be 20, could be 30, could be 40 years, which is not obviously in comparison to what actually the asset life should be, whether it be 3, 5, 7, 10, 15, or whatever, depending on the asset classification. That happens actually quite a bit, and that cost segregation can actually cause significant problems. Other deficiencies that occur for organizations: poor communication of documentation of asset movement. Most organizations do a really, really good job of tracking asset acquirers' purchases. They book them appropriately. But what typically doesn't happen is the disposals or the retirements don't necessarily get tracked very well as should be. So essentially every asset that comes in the door, in many cases, there should be a corresponding asset that goes out the door unless that organization is expanding. So in many cases, assets could be acquiring 50, 100, couple hundred assets, and at the same point in time never retire a single asset. So basically the old stuff never gets taken off the books. And I'll kind of go into a few issues that actually causes. So organizations typically do a good job booking them. They don't do as good of a job of removing them when they're disposed of. Lack of identification of fixed asset impairment. Definitely some deficiencies as it relates to capitalizing repair costs, maintenance fees, things like that. Many times there can be assignment of unreasonable useful lives for depreciation. As I mentioned, the CIP entry before. Having equipment lumped under a building construction entry for 30 or 40 years is definitely inappropriate, especially if it's a piece of computer equipment or even a piece of furniture or manufacturing equipment. A lot of organizations will delete fully depreciated assets from the subledger. I'll get a couple scenarios where that causes a problem. It's always our recommendation, if an asset still is out on the floor, is being utilized, even if fully depreciated, that asset should still sit on the books. There could be insurance valuation implications, there could be tax implications, and there could be other implications that you may not be considering if you remove those fully depreciated assets from the subledger. And then many organizations, don't necessarily provide or do a periodic physical inventory, whether or not that's done by them or hired an outside firm to do it. So very infrequent use can actually cause some deficiencies. Now, before we actually get into some of the implications of some of these deficiencies, I believe we have time for a polling question, so I'll turn it back.
Thank you so much, Mark. And this is the second of 3 polling questions we will pose, and we want to find out from you is how often does your organization undertake a fixed asset inventory and reconciliation? What you can feel free to do is select the radio button that corresponds to your answer, and then click on the Submit button. From top to bottom, the choices are yearly, every 2 to 3 years, that is at least 2, no more than 3 years, every 4 to 5 years, every 6 to 10 years, never. If you don't know, that's fine. You can select the radio button next to I don't know. But once again, we want to find out from you, how often does your organization undertake a fixed asset inventory and reconciliation? What you can feel free to do is select the radio button that corresponds to your answer, and then so that we can record your response, you would click on the Submit button. Again, just to recap the choices from top to bottom: yearly, every 2 to 3 years, every 4 to 5 years, every 6 to 10 years, never. If you don't know, you can select the radio button next to I don't know. You can select the radio button that applies to your answer, and then click on the Submit button. What we will do is give you just a few more seconds to respond to the question, and then what we will do is reveal how you have responded. And so far, what we can see is that a plurality have indicated yearly. Then the next most prevalent response is every 2 to 3 years. A significant percentage, more than 16% of respondents have indicated never, and what also intriguing, a significant percentage, about a seventh, have indicated they don't know. Before we continue, Mark, I am curious, do these responses correspond to what you've seen in your experience?
Yeah, they're typical. What I find interesting about the responses is even though there's similarities to the last polling question, the fact is that 30% to a little bit more people say either never or I don't know, which doesn't quite correspond to the first polling question about how confident they are in their fixed assets. So interestingly enough, for organizations that haven't conducted a physical inventory, either never or really don't know, might be interested in to relook at that to see just how confident actually are you. And then the ones that are the yearly to every 2 to 3 years, I think is great. Once you get up to 4 to 5 years, depending on the institution, there could start to be a lot of turnover. So really what you're looking at is half of the organizations, maybe a little more than half, maybe 60-40 split is, yearly to every 2 to 3 years, with the remainder being anywhere in the greater than 4 or I don't know.
No, and I think we're certainly speaking to the people who may not know what they may not know. So I think this is a great segue and a great opportunity to continue our discussion.
Okay, thank you very much. So we talked a little bit about some of the deficiencies, and so what are some of the fixed asset record implications that are out there? Well, one of the issues that pops in definitely is an audit issue. These could be both external and internal audit issues. Now, granted, you don't typically have auditors parachuting in for a surprise audit. You typically know when they're coming, but essentially they might find results that may in fact actually be surprising. And over the years, those various audit opinions can definitely cause heartburn for management as well as the board. Another issue is personal property tax. Now, granted, this is not going to impact states that don't assess taxes for personal property. However, many states actually do assess taxes on personal property. So anytime you have assets sitting on the books that are no longer there, you may be looking on paying property tax on those. Keep in mind, there's always some minimal residual value of assets sitting on the books. And our studies basically show that could be anywhere from 10 to 20%, even as high as 30% of assets sitting on a client's fixed asset accounting records do not exist, which means you and your organization are paying taxes on those if you are in a personal property tax jurisdiction. That immediate finding can be a direct cash savings not only in year one, but definitely in years 2, 3, and beyond. So other implications are inaccurate insurable values, and what we're talking about there is the replacement values of contents within your various organization. In many cases, the insurance valuation can be based on the fixed asset accounting records. Inaccurate fixed asset records could lead to potential undervalue or as well as overvalue. Mentioned organizations sometimes delete fully depreciated assets even though they still exist. That could result in an undervaluation, or organizations that haven't cleaned up their books might have 10 to 20 to 30% of their assets sitting there that no longer exist. Could be a potential overvalue, things that need to be considered. Also, bad data can be trended, which can lead to bad values. Makes it very difficult for organizations to budget for their expenditures annually as far as their capital budgeting. If you go through a merger and or acquisition, there's very poor detail that could actually be there for that fixed asset merger or for that merger or acquisition. And I mentioned this earlier, fixed asset issues just typically don't happen overnight. They tend to sneak up over time and kind of blindside organizations. So really what CEOs, CFOs, and others are looking to do is protect their organizations. So one of the things that always needs to be kind of made apparent. Sometimes you don't think there's an issue until it kind of bites you in the backside. So they do sneak up on you, and they don't typically happen overnight. But essentially, just with those implications and various deficiencies, no worries for you and your organization, especially those that haven't conducted an inventory in a while. There is a cure, and it's almost as easy as just pressing the easy button. Now, maybe it's not quite that easy, but essentially it's not that overly complicated either. A couple things that need to be looked at. Organizations should really do what I call a diagnostic consulting service. And what I mean by that is doing a deep dive, hard look at your existing policies and procedures. These might be written, they may be unwritten. What I'm talking about is the policies and procedures your organization uses on each asset, from essentially its birth to its grave, how an asset is essentially budgeted for, purchased, received, possibly tagged, loaded into the subledger, who's revolved around it, who's responsible, the individual responsible, and then how you handle disposals. It's a good opportunity to kind of look at your existing policies and procedures. You can definitely identify process improvement areas. So from there, you can either enforce, enhance, or if you're an organization that does not have any type of policies and procedures in place, I could strongly encourage you to actually develop something and write them up as it relates to the individual procedures and the individuals involved. Very, very important to monitor your policies and procedures. But we talk a lot about inventory. Organizations have hundreds, if not thousands, possibly tens of thousands, and even some hundreds of thousands of fixed assets that could be spread over one or two locations, or could be spread out over hundreds over a large geography, and it's very, very challenging to sometimes do an inventory of that. So from an inventory and a reconciliation standpoint, I'll talk a little bit about what's currently being done by organizations and what we in the industry consider to be best practice. Now currently, and I noticed with a lot of the companies based on the poll questions, we're conducting inventories sometimes yearly, sometimes every 2 to 3. At this point, I don't know if they use an outside firm or if they do it internally, but a lot of organizations that do it internally, as I mentioned, many companies haven't, but for those that do, there is some challenges. First of all, those organizations are typically working with those poor descriptions we talked about earlier, how those assets were logged in. They typically have lack of experience in conducting inventory. And really, these next two or three, I think, are kind of big ones. Does the staff really allocate the appropriate amount of time to actually do the physical inventory? In many cases, it's done in what we call a book-to-floor approach, which means here's my listing of the assets. Somebody downloaded it from me for the fixed asset accounting records. I kind of take a look at it. I go out. I might kind of put my thumb up in the air, test the wind, and say essentially, hey, it looks pretty good. Or someone might see on their information, boy, I have a lot of assets here that I no longer have anymore, but if I report those, I might get myself a little bit in trouble. So there could always be a fear of reporting that. So are you actually getting an accurate assessment back when you're doing it internally? And then this one, which I see quite often, is this no reconciliation or review of asset quantities. And what I mean by that is just picture any department that has 20, 30, 40 employees, and it's just a simple office environment. They have furniture and fax machines and printers and computers, and they get the fixed asset accounting listing, and they look at it, and they just kind of look at it high level and say, yep, I got some computers, a couple faxes, a few printers, some furniture. Yeah, that's kind of what I have. Actually looks pretty good. Sign off, move forward. Well, but did anyone actually really review the asset quantities? Did they in fact see that they have 20 employees, which means they have 20 computers, but their listing shows 25 or something of that similar nature? A lot of times that does not actually happen. But, organizations do from time to time perform more comprehensive inventories, which leads into what we consider to be best practice, which I'll get to in a second. But I wanted to just illustrate here real quick as an example of a potential issue that can come up from lack of review of asset quantities or a little bit more of a deeper analysis. So, and I admit I'm using a large example to illustrate a point. But what we have here is a manufacturing client who actually purchased a packaging system with a conveyor belt a couple of years ago and booked it. And you'll see it's a significantly large asset, $2 million capitalization. Just looking at basic straight line depreciation from an acquisition day of 2012 through last year's fiscal year end, depreciation is $333,333. Not a big deal. They booked it accurately. Everything's accurate. Well, what happens is a couple years later, for whatever reason, they decide that conveyor system is no longer working. The belt is inoperable. It's not the right size. There's something inaccurate about it. And they say, you know what, we're going to have to basically mothball the original conveyor and purchase a new conveyor, which is much better for our operations. So they go out and purchase a new conveyor system, which in this case costs $350,000, and they book it. Nothing wrong here with the booking of the entry or the depreciation. The challenge comes in this case of, did they actually dispose of or remove the original existing conveyor system from the original entry? So if we go back here to the original entry, it was booked for $2 million. For argument's sake, and just to keep things simple, let's assume that in that $2 million, $350,000 is allocated to a conveyor, which means the packaging system is $1,650,000. The conveyor is $350,000. They now book another $350,000. They do not remove the original asset. What ends up happening? You have an overstatement of $350,000 in cost. Obviously, associated depreciation, a significant amount of book value. So now this is a large example, but these types of examples happen all the time in organizations. It's simply things with furniture, computer equipment, healthcare environments, you name it, especially technology and healthcare and others where there's a lot of asset turnover and a lot of purchases. This type of example can happen from not removing assets in a timely manner. So try to jump into best practices. First off, hire Dilbert and his little buddy here to go out and do some asset tagging because he knows that staplers aren't considered equipment. But with that all being said, we definitely recommend conducting those wall-to-walls every 3 to 5 years. Those poll questions, for those that are doing it in that yearly to 3 or 4, definitely within that time frame, we think that's good. Large organizations may want to do it in a cyclical approach, just really might be difficult to actually do it internally over a short period of time given the number of locations. Definitely always recommend conducting that inventory consistent with the current fixed asset capitalization threshold. most importantly when you do this, whether you do it internally, you hire an outside firm, you name it, really need to do it in the shortest time frame possible. Assets move. Computer equipment, manufacturing equipment, production equipment, you name it, stuff is highly mobile. You want to kind of get in there, inventory it, and get it before it moves out. Also, because a lot of assets are never entered into the subledger correctly, you want to capture the appropriate data. You want to record its locational information. What building is it in? What department? What floor? What room? Grid location, any other type of locational information that may be out there. Record unique manufacturer, models, and serial numbers. Possibly, if not, definitely really request or at least recommend organizations to use property identification tags. You want as many identification features on a particular asset as possible. Make, model, serial, location, tag number, you name it. A number of different means that you can track that asset not only today, but definitely in the future. Then from a reconciliation standpoint, it's one thing to go out and do a physical inventory and capture everything. It needs to be reconciled. So when you're doing is you're comparing that inventory back to the current records. You need to basically identify what's there, that being the matched assets, unrecorded additions, and unrecorded retirements. And those unrecorded retirements are definitely very impactful, as we talked about earlier, from a tax standpoint, and also can be an issue from an audit standpoint as well. How is that reconciliation process done? Well, it really needs to be done what we call here kind of a line-by-line approach. You need to look at very much a number of different angles, tags, serial number matches, various manufacturers and models, or other information that might be already captured in the fixed asset accounting ledger, as good as it can be. There's going to be a lot of bulk purchases, group entries. I'm sure most organizations and a lot of you on the call today have entries on your books that are either just equipment for several $100,000 or entries like 100 computers or 50 printers or 25 hospital beds or you name it. Those things need to be allocated out to unit by unit control. And to kind of illustrate some of those allocations, just to kind of give you a before and after type look, if you see on the top here, there's an original entry, which we see on a lot of clients' fixed asset records, an entry that says 6 computers. No tag number, some costs, and associated accumulated depreciation. Well, a good solid inventory will basically inventory 6 individual computers. Now, I did not list manufacturer models and serial numbers here because of space, but you essentially know that they were there. Each computer will essentially get a unique tag number, which gets fixed, and then what you can do is basically split out or allocate the total cost, the total accumulated from one entry down to 6, just doing some simple math. So essentially your fixed asset accounting records can be basically take 1 and essentially replace it with 6, which gives you much better unit control going forward. One thing to keep in mind, too, when you're doing this, especially from an internal and external audit standpoint, you need to perform and use audit trails, basically how you got from point A to point B. If you conduct your own inventory, reconcile back to your accounting records, you're going to want to maintain some form of an audit trail. So when your internal and your external auditors take a look at it and say, all right, you have this nice clean record, how did you kind of get from your old record to this new record? That audit trail can basically do that. It identifies how you addressed each asset, and then provide some sort of a unique link between each of those assets as well. Talked about this earlier, capital budgeting. A lot of organizations talk about how challenging it is sometimes to know how much dollars we should budget for annually for new capital. What I want to do here is basically kind of give you an illustration before we jump into the next poll question. I'll show you some of the results. But by having a good physical inventory, you can identify when an asset is going to become obsolete or basically going to get removed. So if you have good inventory, good acquisition dates, good life assignments, you know when an asset is going to have to get replaced. So by looking at the fixed asset accounting records, each line item could have a projected year of when it's most likely going to get removed from the facility. So you know if it's going to happen in 2 years, 3 years, 5 years, 10, 15, or higher. And then you can project, based on some industry trends, what you think the replacement cost will actually be on that asset at that period of time, 2 years out, 5 years out, and whatnot. And before we jump into the next polling question, I'll show you some of the results and how that kind of looks. So with that, I'll turn it over to the next polling question.
Thank you so much, Mark. This is the third of 3 polling questions we will intersperse throughout our webcast. And what we want to find out from you, you may recall when you joined our webcast at the beginning, we had initially posed a very similar question. What we want to find out, this is before and after, essentially. Based on what you've heard from Mark, what you've heard from Chris, and at this stage, we want to ask, how confident are you now about your current fixed asset information? You can feel free to select the radio button that corresponds to your answer, and then to click on the Submit button so we can record your response. From top to bottom, the choices are very confident, confident, unsure, not confident at all. What you can do is select the radio button that corresponds to your answer and then click on the Submit button. And we want to find out from you, how confident are you now, based on what you've heard from Mark and Chris, about your current fixed asset information? Feel free to select the radio button that corresponds to your answer, and then you can click on the Submit button. This way we will be able to record your response. So what we will do is give you just a few more seconds to respond, and then what we will do is reveal how you have responded. So far, what we can see is that a majority of respondents, well, it's not as big a majority, so we've definitely seen some drop-off. And I think that is quite interesting indeed. I think, before we continue, I just want to quickly ask you, Mark, have you seen this as well as when you pose the same question multiple times, when people you've spoken with learn more about what they need to know, do you find that sometimes people become less confident?
Typically, yeah, there's things that they don't think about, no question about that. But we also, have a lot of organizations, too, that actually, feel very confident in their fixed assets, but they may not know it quite as well just because large organizations have so many people that are involved in the process, and, it's very, very difficult sometimes to keep in check with it. But I don't remember the initial results, but as you noted, it definitely seemed to get skewed. I think we have a lot more unsures now. I think there was a higher number of confident and very confident in the first question compared to now.
Sure. And that's not necessarily a bad thing. I think it's a matter of knowing what you don't know, or knowing what one does not know. I think it's a great segue into the continuation of our discussion.
Yeah, so I mentioned the budgeting process. So if you talk about projecting out into the future when an asset is going to become obsolete and needs to get replaced, what you can see here, and just using an example here, if you're sitting in 2015 and you basically know that you're going to be spending about, say, $7.5 million for capital expenditures, based on a good solid fixed asset record, an organization can kind of see that there's a slight drop-off next year, not as much being replaced. 2017 kind of jumps back up to where it was this year, but then you can actually see spikes in the future, like in 2018, or because a lot of stuff is just the way things have been purchased over the years going to become obsolete and need to be replaced in 2018. 2019 all of a sudden becomes a year where it's kind of an off year. So a good inventory, good projections can basically provide information to organizations so they can budget for some of these spikes and kind of prepare for them, knowing that one year is going to be a little bit higher than the next. So something good to consider. A lot of organizations can do this internally. But if you do look to the outside, obviously some real common sense things that should be looked at. You definitely want to focus on firms and organizations that have industry experience within whatever your area of expertise is. You want firms that use technology. You definitely want to look at professional accreditations. I kind of skipped over it inadvertently here, but you want firms that have experience working with the Big Four public accounting firms, because you want to make sure that if inventory and reconciliation is being done, it can definitely pass audit. Do references, no question. And internally, a lot of systems need to be utilized to help calculate depreciation and do other analysis. You want to make sure that those systems are up in line with the various attestations out there, specifically SOC 1, which is, the former SAS 70 and former SSA E16, formerly SAS 70. It keeps changing names, but essentially that's the same protocol. So just to kind of recap on mine before I turn it over to Grant on some technology, just remember, fixed assets are typically the biggest number on the balance sheet. Those fixed asset records can sneak up over you in time, even for those that think are confident. They can sneak up on you over time, blindside your organization. There is a lot more scrutiny out there over fixed assets. We expect it to continue. I mean, many organizations do have good internal controls, but there are a lot of poor controls actually out there. Don't forget to consider updating or enhancing your policies and procedures. These are the written documentation of how you acquire and use an asset throughout its life cycle. Conduct periodic inventories. I'm excited to hear that a lot of firms are doing it very frequently. Great. For those that are not, definitely consider it. If you do need outside assistance, seek qualified fixed asset consultants. I leave you with 2 action items, and even for those organizations that are confident, 2 things to do. Do a quick download of your fixed asset accounting records. So take the detail, put it in a spreadsheet, put it on your desktop, and do two things. One, sort that file from high dollar to low dollar. Look at the top 5, the top 10, top 20, top 50. Pick a number and see if you can actually find that asset, walk out somewhere, talk to someone, get a picture of it, and know that that asset does physically reside. You know, do you find all 50 of them? Did you only find 40 of them? 45? What's the number? See if you can put your hands on it. Look at cost. Look at book value. The second item is also, as it relates to, is acquisition date. Sort that file by acquisition date. If you look at those acquisition dates, do you have information technology assets greater than 5 years old, 10 years old? Do you have furniture greater than 20? Maybe your institution has assets in that classification, but take technology, for example. A lot of organizations have revamped and tweaked their technology. You know, to see something on the books greater than 7 or 10 years may not make any sense, and you may actually see a lot of individual line items and a lot of individual assets that no longer exist. Appreciate everyone's time today. With that, I'm going to turn it over to Grant to talk a little bit how technology can help.
Well, thank you very much for the introduction. As Mark mentioned, my name is Grant Griebel, and I am a solutions engineer with Sage Fixed Assets. I'm going to be talking about how technology can help support the best practice processes that Mark just covered in his presentation. So, we're going to begin by covering some technologies that can help you with the upkeep of your asset information. A dedicated fixed asset management solution or software will make the asset management process much more efficient by removing manual processes and data entry. Additionally, finding a solution for scanning, both a software as well as a handheld scanning solution, can assist in making the physical inventory process less challenging, especially if you're spread out over a wide geographic area. Now, you might be thinking to yourself, as I introduce some of these basic technologies that can be used to assist, why can't I just use a spreadsheet? Well, for a couple of reasons, actually. Spreadsheets are a common starting point for most businesses to begin managing their fixed assets. However, as time goes on, your growing business's needs expand, you add additional employees, the federal tax code continues to become more complex, and all of the dangers of using Excel become more and more apparent until it becomes a stressful source of major business challenges. Now, we already heard Mark talk about these factors and how they can impact your business. With a proper technology solution matched with best practices, you can avoid these challenges. So, what are some of those best practices? Put checks and balances on how data is entered in order to prevent bad data from ever getting into your system to begin with. You can remove manual data entry whenever possible in order to close the door on human error and dirty data. And automate processes whenever you can in order to further remove the human error factor. So what should a dedicated solution include to help you overcome these challenges? First, fixed asset solutions should offer the ability to customize fields, not only to meet your needs in regards to the type of data you'd like to track from a physical and financial standpoint, but also to mark if a field is required, so that it must be completed in order to save an asset in your registry. Or, if you want to put an entry mask on a field, to limit the number and type of characters that can be entered to prevent bad data from getting into the system. Dedicated fixed asset software should also allow you to further control data entry by creating a drop-down list of selections for any field, removing the chance for typos entirely. And finally, a group and user-based permission structure allows you to both control what asset data users can see and what they can or cannot do when interacting with it. The financial depreciation of your assets and the physical tracking of your fixed assets are two sides of the same coin. Look for a solution that ties both of these processes together while allowing each group to accomplish their goals without stepping on each other's toes. There's many different solutions out there that handle this in various ways. Here at Sage, we have our tracking solution and depreciation solution work off of the same database. When accountants add a new asset to be depreciated, users in facilities or IT who access the tracking to perform an inventory will see that new asset and be ready to include it in the physical inventory process. If during that inventory assets are found to be lost, stolen, or broken, identifying them for disposal and tracking will be represented in the depreciation portion of the solution. These users will not be working in the same software. They might not even be working in the same physical location. But with the right solution, both groups are helping each other maintain good asset data, even if they don't realize it. Keeping a close eye on your assets doesn't have to start after they're already placed in service. Many fixed asset software solutions also offer a planning tool designed to help you manage your works in progress. These solutions enable you to set budgets for upcoming projects and the individual assets that make up that project, and then compare them to your actual expenses as the project moves forward. Fixed asset planning tools will help you to manage ongoing projects by keeping a close eye on budgets and timelines, and then when it comes time to finalize a new asset or assets and place them into service, sending them directly into the asset database to keep an eye on the new asset, both physically and financially, throughout its useful life. So I hope that the information presented today by myself and my colleagues was valuable and somewhat eye-opening. More often than not, when people think of fixed asset management, they tend to think of financials and depreciation. In the very least, I hope that after today's presentation, if someone mentions the term fixed asset management to you, you think about both the financial and physical aspects of your fixed asset management process and not just depreciation. And with that, I think we'll pass it back over to Joe or Chris for a little bit of Q&A.
Thank you so much, Grant. This is Chris. Appreciate it very much. We've got a lot of questions so far. Let's get started. First question is for Mark. Who in an organization is the typical buyer of your consulting services? And is there a typical triggering event that causes that person to contact you?
So typical buyers tend to be mostly finance folks, can be CFOs, controllers. Some organizations do maintain some fixed asset management groups, but typically it would tend to be the finance group. As far as triggering events, kind of some of the things you mentioned earlier, could be tax implications, definitely audit issues. One thing that I didn't mention that pops up quite often are software conversions. So an organization is going through a large software, fixed asset software, or some sort of software conversion, going from Lawson to Oracle or PeopleSoft to some other version or some other group to Sage. And when that happens, it's a good opportunity to kind of clean up the essential data. So that's kind of some of the trigger events that we see.
Excellent. Thanks so much, Mark. Next question is for Grant. Grant, you talked a lot about the spreadsheets. The question is, how big does my company have to be before spreadsheets are no longer up to the task of managing my fixed assets? Any thoughts on that?
That's a different point for many people depending on their business. But generally speaking, whenever you have a single point of failure, that's something to be concerned about. And when you're using spreadsheets, there's usually one or two people that are sort of the spreadsheet expert. If your business has gotten to the point where you wouldn't know what to do with yourself if that person was removed, it's probably time to look into alternatives and other solutions that could help.
That makes good sense. Thank you so much. Mark, another question for you. How important is industry expertise in undertaking fixed asset tracking? Are the consultants you work with generalists, or are they specialists by industry?
Well, it probably depends on the industry. I'd say certain industries it's probably not as critical, but others I'd say it's significantly critical. So if you're in a technology environment, a manufacturing environment, even like a healthcare environment, those types of areas, you definitely want industry expertise. You're not just talking about simple laptops and printers and desks and chairs. You're talking about high-tech equipment, MRIs, manufacturing systems. You think of companies like Nike or Kraft Foods or things like that. You're talking about high-end equipment that's very unique. So you definitely want to have some industry experience if you're going to conduct an inventory of it. You're not just counting pieces and parts and simple things. So it depends on the industry, but I would say definitely within some of those environments, you definitely want that.
Thank you very much. That's great. Question for you, Grant, is it possible to incorporate a fixed asset depreciation solution into my company's larger financial systems?
Yeah, absolutely. Most fixed asset management solutions you're going to find are aware of the fact that they have to play in the larger financial space, usually in regards to an enterprise resource management solution or enterprise resource planning solution. And you'll find that actually a lot of ERPs do offer built-in fixed asset modules. One thing I will mention about those, if you are considering that, keep in mind that a lot of those built-in fixed asset modules in ERP systems do not include the tax laws, so you won't get the updated tax information, and also do not cover the physical aspect, doing the inventories, everything that we talked about today. So while you do want to make sure that whatever solution you get can integrate and work with or at least pass data back and forth from an ERP solution, don't think that getting a bundled fixed asset module with an ERP will solve that problem for you. It can actually put you in a worse spot. So make sure you do your research first.
Thank you so much. I have a more tactical question, and I'm not sure which of you it's for. Someone has a question about barcoding systems versus RFID tags. Are any of your asset tagging systems moving to RFID, or are they sticking with barcoding?
I can answer some of that. The answer is in some cases yes, but in many cases no. It depends. A lot of organizations that are using RFID, it's for certain types of assets. It may not necessarily be fixed assets. It may be certain types of trackable, highly mobile assets. Don't know of a lot of organizations that are using RFID to track specifically fixed assets, and part of the reason why is it's quite expensive. We are seeing a few more go to it. The technology is getting better and more efficient, but essentially the cost is still pretty significant for a lot of organizations to use it on all fixed assets. They tend to use it on more specifically highly mobile, highly disposable, highly expensive assets that they really want to know exactly where they are at any moment in time. Healthcare environment, things like that might be more emergency related. I know that's not 100% across the board, but that's what we're seeing in most areas.
I would absolutely agree with Mark's statement there, is that it's usually things that are very mobile, and a lot of times it's just a simple, yes, is this here, and where is it located? RFID is great for that. You can even put gates where things are shipping in and out saying, yes, it's here, or no, it's being moved to this location. Where RFID does have a bit more of an issue is it doesn't give you those details. It'll say, yes, it's here, but it won't say, yes, it's here, it's tied to this department, it's on this floor, in this room with this serial number. So usually things that are moving around quite a bit, but it's more often than not quite as detailed from an information standpoint, at least the few that I've seen.
Thank you very much. We're at the top of the hour, so I'm going to ask one last question from the audience. It is, traditionally we think of fixed assets as hard, tangible pieces of equipment. Today, large purchases can be made from software. Should large-scale software purchases be treated as a fixed asset and tracked in that way?
The answer, as I say, essentially, yeah, they're large. They can be capitalized. One thing I would definitely say, though, if you are doing that, if you're in a personal property tax state, though, make sure those assets get isolated and identified just because of the exemptions on software. But essentially, we see that all the time, especially with some of the largest software systems that are out there. It depends on the organization, but essentially I would answer that question is yes.
Excellent. Thank you so much. I'm afraid we've run out of time. Thank you for all the questions, and the people from Sage and American Appraisal will get back to you with answers. And now back to Joe Fleischer.
Well, thank you very much, Chris. Thank you very much, Grant. Thank you as well, Mark. On behalf of our very distinguished speakers, Mark Bauber, Managing Director of Fixed Asset Management and Insurance Solutions with American Appraisal, a division of Duff & Phelps, Grant Griebel, Fixed Asset Solutions Engineer with Sage, and our moderator and speaker as well, Chris Schmitz, Director of Research and Custom Content with CFO Publishing. We all very much appreciate your joining us for our webcast. Will your fixed asset controls stand up to an audit? Brought to you by CFO Publishing and by the sponsor of our webcast, Sage. We thank you for your time, and we hope you enjoy the rest of your day.